Hello, everyone, and a very warm welcome to this Friday's Major Markets Update for September 20th, 2024. Well, what do we have? Well, we are going to talk about our alternative Elliott Wave counts. They are only triggered on breaks above or below the bullish or bearish warning levels, depending on if we have a preferred bullish wave count or a preferred bearish wave count. They are our insurance policies. We have our preferred wave count. In this case, it's bullish, a ending diagonal. Please note, ending diagonals are extremely unreliable because they're overlapping ABC structures as our preferred wave count. So expect the unexpected. However, we've placed strategic warning levels telling us that this further upside will not happen. That is just to make sure that we are not banking on the wrong path. That's all there is to it. It's not to claim, see, I was wrong or right anyway, right? That's not what matters. I don't care about being right or wrong. That's not why we're in the markets. Of course, I want to be right as much as I can, but that, about 70% of the time we are right. And sometimes we're like 3 times in a row wrong. Okay, that is very unfortunate. That happens. Why? Once again, I keep reiterating it to the limited mental capacity people out there, honestly. And I know you as my premium members are not, though some have been, trust me, but currently we have a great group with a lot of input. And that's why I'm going to bring this up as well. And don't take any offense at all. It's simply that we need to ensure that we stay on the right side of the market, and that if we are indeed betting on the wrong side of the market, we get out as quickly as possible with as little loss as possible. We have that, of course, in our slide. But always when I write an article and post it on for example, FX Empire, well, they don't have any comments, but investing.com, there will always be somebody saying, oh, you're saying it can go up and down. Yes, indeed. They fail to recognize that we prefer a certain path contingent on holding above or below certain price levels. A lot of people have simply difficulties with understanding possibilities and probabilities and dealing with a complex system that simply cannot be predicted accurately and reliably all the time. If so, the stock market wouldn't even work. The stock market won't work if you can predict it all the time, because everybody would always know exactly when to buy, when to sell. And then, of course, there's no price discovery, right? That is the whole point of the stock market, is price discovery. Anyway, our alternative wave counts are our insurance policies. They help us, if they get triggered, understand where we were wrong in our assessment and what it is instead. As I always say, when one door closes, another one opens. Sometimes when you step through one door, then you have 2 more doors. And you step through another one, there are 3 more doors. You step through another one, then there's 1 more door. It varies. And again, we can be wrong sometimes 3 times in a row. And then we're right, sometimes even like 10 times in a row. And I always get very cautious when I'm right 10 times in a row, because then, of course, the statistics start to kick in saying, well, it's time for you to be wrong again. And that's why we have our Elliott Wave counts, the preferred one and the alternative one. Sometimes there are more alternative ones than I would like, but we have to remain objective and do not focus on those. Focus on the preferred one. That's what we focus on. We've continued to say upside, upside, upside. Yesterday was definitely a surprise because we got a very shallow 23.6% retrace, which is not impossible for a second wave, just quite unlikely. Due to that, some of you suggested maybe the Federal Reserve's low was a 4th wave, and that is possible. So that is now becoming our alternative point of view. These are our structures we follow. 1, 2, as 1 is the impulse, the leading direction. 2 is the corrective. 1, 2, 3, 4, 5 for 3, leading. 4 is corrective. 5 is leading, and then etc. And this is, of course, very simplistic, but that is what we're following. And again, always remember that we cannot be right all the time. There will be losing trades along the way. Yesterday, I had to take a loss. I bought some inverse ETFs because I thought we would go to that 55.25 plus or minus 25 level on the S&P 500. Why? Because the odds are highest to reach that level for a second wave. I had placed a stop loss at Wednesday's high, just slightly below it. And my inverse ETFs got stopped out pre-market. It happens. You know what? It was a hedge. It wasn't my entire portfolio. I think it was just 10% at the most, maybe 5% of my entire portfolio. So, you take just a small hit, predominantly long. It's a hedge. It wasn't my entire portfolio. And it happens. So I had to bet, of course, on the odds. I put my money where my mouth is. My preferred wave count was still longer, intermediate term, right? The 3, 4, 5 in the ending diagonal. So, of course, my core position is long, but I do want to hedge it and maybe get some money out of a potentially 100, 200 point drop, whatever the number was. And it didn't happen. All right. It didn't happen. That's fine. I took the loss. I couldn't care less. It's on my spreadsheet right now. And all in all, that day with that loss, I think I was still up. So it happens, all right? Because the core positions are, of course, much larger. I'm up for the week. It's all good. It's nice and dandy. And that was actually my first losing trade of the entire month. Yeah, I'm not patting myself on the shoulder. I'm such a great trader, but just to show you that, yes, once in a while we get it wrong. Okay, so don't go to mama and cry if you get a wrong trade. Don't blame me. It happens. Okay, just because a 50, 62% retrace is more normal, happens more often, doesn't mean a 23.6% retrace cannot happen. But you got to take the odds. And if the odds favor a certain trade, I'll take it. Well, it didn't happen in this case. Sometimes it does, sometimes it doesn't. Anyway, that is, of course, the importance of stop losses and why we have those levels in place. As soon as I entered that inverse ETF trade, I knew I cannot see price go above today's high on Wednesday, because then we're most likely going to go to 6,000 plus. So then some of you wondered if we are still going back to 5,500 anyway. Yes, it is, of course, possible. Is it likely? In my humble opinion, not. Otherwise, I would have presented it yesterday, but we'll see. And if you do not like to trade with those type of uncertainties or probabilities, please use my ETF trading alert service. Super easy. All you need to do is follow, if you so desire, the algorithm-based trading signals: buy, sell, hold, set stop, raise stop, etc. Take a loss, whatever it is. ETFs, perfect. Secret service as well: Apple, Amazon, Google. Oh my God, it's been really, really fun to trade. Yes, we've had a couple of losers. Most of the time there are losers in the short positions, but they're tiny. Why? Because it's a predominant bull market. And if you don't want to short, you just stay in cash. Cash is a great position too. And remember, the gold and the gold miners, they are ripping, rip higher again for the week. So that's great. I like it. I like the gold and the miners. I've liked them for 2 years and I'm sticking with it. They have been a nice cash cow. So we're going to go through all this good stuff on, this is, predominantly bigger picture for the stock market, sentiment, confidence, that kind of good stuff. Why there's always a compelling reason to sell, that it sometimes takes a long time before you get back to break even. But, from big gains come, from big time frames come big gains. From small time frames come small gains. And careful with the losses. The math is always stacked against you when it comes to losses. There we go. Link to the charts. Here we go. S&P 500. So I'm going to cover the alternative wave counts to show you the insurance policies. Okay. So this is our preferred wave count, has not been disproven. We've raised the warning levels for the bulls. The first warning level was today's low. We didn't even close below it. Okay. Yes, we got an intraday stab below it, but that is it. So I cannot tell you if we've topped or not in that sense. Have we topped? I don't even have a inkling clue from these warning levels. And they're there for a reason. Of course, we want to stay above Wednesday's spike high, right? That is, of course, a critical level. And we're holding it. We're holding even above the July previous all-time high. So, no, I have Zero indication we've topped. Instead, we're at the upper Bollinger Band. We're above the 10, the 20, the 50, and the 200-day moving average. Here on your left, you can see the 10 is rising. It's above the 20. The 20 is rising. It's above the 50. The 50 is rising, and we're above the 200, and loud and clear above the green Ichimoku cloud. So this is a 100% bullish trend. The MACD is on a buy signal. Money flow is still positive, starting to point back up again. So zero indication of top is in place. We need to at least close below Thursday's low. That might now be shifted maybe lower to today's low. I don't care that much about these tiniest of differences. So we'll keep it as is. So this is our preferred wave count. Now, what if this is wrong and we've indeed topped, although we have zero indication this is the case? Market breadth neither. And there are a few tiny warning signals there I'd want to show you, but we haven't even reached those warning levels yet. Regardless, this is then our, of course, alternative wave count that we had 5 waves up, 1, 2, 3, 4, 5. It could be counted that way. Some people suggest that might be the case. It's not my preferred wave count, but in case I'm wrong, then this is, of course, the top we had on Thursday. And we're now going to decline once again to about 55.50 plus or minus 50. And from there, we're going to do the C3, okay? Expect the unexpected, especially in a ending diagonal. This is a ending diagonal we had here in February, March this year. And you can see how overlapping it is. Up, down, up, down, up, down, up, down, up, down. Very, very tricky. And you just have to pretend your nose is bleeding and just hold on to it, because this is, of course, very difficult to trade short term unless you are a pro, like my dear business partner at North Post Partners. And he is at NPP Trades on X. So please visit him. Great stuff. High respect. His name is, of course, Russ, and he does fantastic stuff. Pro trader. And you got to follow him. Anyway, here we are. This is the alternative, but we have to close at least below Thursday's low, which is at about 5,700, somewhere around there, maybe a little lower. I don't even know it from the top of my head, but you can see we haven't even closed below it. And I go by closing prices because every time the market opens, the most important price is the closing price. That's what we are chasing. That's what we're going after. So we have then a potential drop to 55.50 and then move higher. Okay, so this is our first alternative wave count, our first insurance policy. We start breaking below 55.50. Something else might be going on, and that is that we have still a potential larger B wave top. Okay, this is still a possibility. We're going to raise the warning levels for the bulls because we haven't done that on this wave count yet. So here we go. This is, of course, the first warning level. And you can see how Thursday's low pretty much retested Wednesday's high. Okay. And then the second warning level is, of course, Wednesday's low. And then the third warning level, we'll keep it as is for now. So this is still possible. And this will be more likely if we start breaking below 55.50 and especially 5,500. Why? Because if we break below 5,500, I would say that will then go below the 76.4% retrace. But for this wave count here, the ABC, we have, of course, a little bit of higher third warning level, which is at about the 62% retrace. For this wave count, it's a little bit lower. All right. We need, of course, a little bit more leeway to suggest we're on our way back to 5,100. Yeah, it's possible. It's absolutely possible. I have zero indication this is the case, especially with a 100% bullish market and setup, right? This is 100% bullish. So why should I turn bearish? NASDAQ 100, this is, of course, the wave count we shared with you yesterday. We are on our way to about 20,500 or 600, potentially stalling out at around 20,200. Okay, so this is our preferred wave count. Now, we do have, of course, the A, the B, and the C. It's this red B, of course, needs to be moved here. Okay, so this is then, of course, A. This is, of course, B, and then we could have topped here for wave C already. Okay, we don't have to close that gap. So this is, of course, still possible. Please note that we're holding, of course, the bearish warning level, and we've broken above 3 of them. So most likely this is not correct. And then, of course, the ultimate is that we going to challenge the all-time highs for some sort of flat, an A, a B, and a C. Okay, so this is akin to what we see here, with, of course, this potential having already topped for wave B, which is a marginal higher high intraday yesterday, and that's it, A, B, C. It's very possible then this wave B was a flat. And again, in this case, we need to break at least below today's low to start trigger this possibility. Okay, I've put it in here at the yesterday's low. It's fine as well, 19,700. We closed below it, first warning level. More importantly, I would say that is Wednesday's low. I think that's a more important low than any other low this week. Okay, neither Monday's low is as important. I think Wednesday's low is critical. If we break below that one, we'll go towards a more bearish setup. But please also here, we're above the moving averages, and the moving averages start to get bullishly stacked. So the 10 is above the 20. Which is above the 50, which is above the 200-day, and we're above the Ichimoku cloud, which has turned green. So this is a bullish wave count. And I'm still thinking that we see this gap fill here. Because remember, it is either an ABC lower right there, or it is an impulse lower. One of the two. Still can't figure out exactly which it is. I'm sorry. We can throw everything at the kitchen sink at these wave counts, and both of them are still valid. So those are the two options and insurance policies we're tracking, with, of course, the preferred wave count higher, as you can see here, higher here as well. And then we'll see if it's going to be a new impulse, meaning then that the August 5th low was a fourth wave lower. To be determined. But again, zero indication of the top is in place because we haven't even broken below the first warning level. Yeah, we broke below it intraday, but doesn't matter. It's closing prices. If we'd broken and closed below to yesterday's low, that would be a first sign like, we might have to adjust to the bearish wave counts that I also presented for the S&P 500. So the Dow Jones, yeah, it made a new all-time closing high. Yeah, it's not bearish. So we still prefer this wave count. Continued on holding above, of course, Thursday's low. Can also be today's low. It's fine. It's potato because it's such a small difference. But this looks good. Long and strong. So zero indication the top is in place, other than Wednesday's low fell completely short of the ideal wave B/2 target zone. Well, then it's a very bullish market. Oh, how nice. So we still think then that we are in this bigger picture C wave. Okay, so a CSA relationship targets 43,000, which is getting very close to this 200% extension and very close to this 200% extension. We have now two up weeks in a row. It doesn't look bearish at all. This is bullish. We've raised the warning levels for the bulls. So the new warning level is around this week's low, as you can see, which is very close to last week's close, which is very close to the weeks before's open, etc. So this is a critical level at around 41,500, 41,300, 400, somewhere around there. Okay, this week's low, 41,400, somewhere around there. Okay. And a CSA relationship for this expanding ending diagonal wave 5 would look really good, unless this is a 1-2 setup, and will completely be smoked out of the water, and probably target close to 50,000 instead. But for now, this is what we prefer. Why? Because of this very overlapping price action. And remember, in a expanding ending diagonal, the fifth wave is the largest. The first wave is the shortest. The third wave is the second largest, because third waves can never be the shortest. Very simple. So this would match as well. And look here at these upside targets, 43,000, almost 44,000, and it matches really well with these bigger picture upside targets. So for now, we prefer to look higher. So we have a bullish week. We're up 1.6% for the week. I don't know why that should be bearish. But we have our warning levels in place, and so far not broken below anything. So all those alternative wave counts we have are then just alternatives and our insurance policy. Insurance policy for that the market is in a bullish trend with a 100% bullish chart. So we should be bullish, but we're not ignorant and we're not pigs. So we're not going to get slaughtered, right? We want to get out before the shit hits the fan, of course. On any time frame, doesn't matter if you're doing short term or intermediate term or long term. That's why. That's why we do our ATF trading alerts. We do the SPY, for example, for the long term, the SSO, SDS pair for the intermediate term weeks to months. And then, of course, the short term is the 3-time ETF. You have to use the appropriate ETF for the appropriate time frame. And we always place stops. Anyway, So that's what we're at. This has not changed this point of view for the last 4 or 5 weeks. So far, so good. All right, let's look at the bullish percent index. So this one is starting to show a few warning signs in that if we go back in time here since 2022, I know it's limited. Anytime we go pretty much above 75 into the 80s, it's getting close to a top. Okay, there are exceptions like here late December last year, but otherwise, I know this was a bear market, but also here in this bull run from the October 2022 low into the summer high in 2023, if we get these very extreme readings, it means we're getting pretty overbought and it's time to get rid of it. Okay, so we're at 77. I'd like to see a little bit higher. I'd like to see it go into the 77.5 to 80. That'd be a fantastic sign. Now, we have to point out that this is the bullish percent index for the NASDAQ 100. It's not as related, I would say, as that for the S&P 500. So we're actually going to focus on the same thing. And this is for the NYSE bullish percent index. And also here you see, if you get these extreme readings into the high 60s, at least above 65, we're getting close to tops. Okay, there's a few, of course, bull runs within this bear market in 22 that have lower readings, but we want to compare apples to apples. And that is, if you're in the bull market and you get these readings close to 70, it is maybe time to become a little bit more cautious. Now, if we get these extreme readings into the 80s, that is a strong bull run. Okay, this is a whole different regime than we're currently in. So this is like kickoff waves. This is so much strength that will just vibrate through time and price for a long time, as you can see. And also you can see how long negative divergence lasts before it eventually matters. So the bullish percent index for the NYSE index, which is like the Dow Jones, this is a broader market index, is going towards, well, we could expect a local top, right? Okay, then we're going to look here at the wave count we have. Well, that could be this third wave top, because it doesn't look like we're just there yet, but it is a, keep attention, pay attention. We're not there yet. AD line, on the other hand, as you can see, that's bullish. I was definitely on the cautious side for a long time because it took a long time before we made a new all-time high. And that hadn't happened for a long time. This was one of the longest stretches since the 2009 low, if not almost longer than the bear market from 08 and 09 to get back to new all-time highs, where it's new all-time highs. And if we go back in history, bear markets never happened with new all-time highs. We need to see negative divergences. So long-term, this begs the question, are we indeed topping? No, not according to this indicator. Do we get sometimes scary market corrections with new all-time highs? Yes, like here in 2020. Yes, like here in 2022. Yes, like here in 2018. Yes, like here in 2015. Yes, like here in 2011. So this doesn't exclude scary bear markets or corrections, but it does tell us once those corrections are done, we should expect new highs. That's what it tells us. And for now, we have zero indication that a top is in place. How we're doing on the new lows, they're very low, 11 for the NYSE and about 87 for the NASDAQ 100. Those have been elevated for eternity in the sense that they barely ever budged below 50, which is fine. Yes, of course, if you get this low, there's only room for improvement, so to say, right? But this is benign. Compare that with peak highs, we need to get into the 50s to at least suggest that, okay, we're correcting. So this is benign. This is not bear market territory, right? We always want to be on the lookout for if we're going to get rug pulled. So this is then market breadth. It looks a little dire. It's about 2. It's not great. Yes, we have this negative divergence, but it can last a long time. And sometimes we have negative divergence throughout a bull run. We've seen it before. So yes, we're starting to see here also negative divergence. So again, these are some smudges on the otherwise clear window. These ones do suggest careful. But I do again want to point out, look here, we had a sell signal, and what did price do? It rallied. We had a sell signal, what did price do? It rallied. So it's not necessarily a slam dunk. Okay, it's really not. It doesn't mean that if we get a sell signal now, the price will go higher. We'll have to look for price levels to know it's not going to happen. But we're still in a buy signal ever since mid-August, and that one has been quite successful so far. Yes, we had this drop here in September, but we're back to new all-time highs. So what does this one tell us? Well, okay, there's a smudge on the window, that's for sure. But the window is never clean on Wall Street anyway. It's all dirty tricks. No, it's not. This is just objective analysis, and we have to be aware that, yes, we can sometimes get sell signals, but the market powers through it. How we're doing on the PMO buy all sell all indicator, it is still on a buy. I'm pretty sure it's going to be topping out here at around 93. We did the same here in May, somewhere around this level. Then we got another spike high higher, a sell, etc. We've had very clean, clear buy sell signals over the last month to 2 months. So this is pretty good. I like it. And as long as it's on a buy, it's on a buy. And the KST has now confirmed this buy signal as well. So that's good, right? Again, this one doesn't suggest that the top is in place, though the indicator is topping out. But that doesn't mean the top is in place, right? We have oftentimes very long periods in time, like here, and then like here with a one false sell signal that can last, in this case, 2 months before you finally got a bigger sell signal, which then gets resurrected to a buy signal, etc. So for now, this one doesn't tell us either, oh, it's a sell. So then we're going to go back again to what hasn't been working. That is seasonality. This is average seasonality over the last 96 years for the S&P 500, which suggests we should be in the gutter for the index, right? We are now in September 20th. Look at this, right? This one suggests a bottom or top in September 6th and then decline all the way. But we got exactly the opposite, right? We got a bottom in September 6th and we've rallied. So we are doing exact opposite of what seasonality on average should do. So this can be thrown out the window. We'll keep tracking it till it works. For now, it's not following average seasonality. How about election years? Sure, we're going to look at election years. Election years tell us also we should find a top somewhere early September, and then a low a couple of days ago, and then a spike into about today, Monday, and then a drop. Okay, well, we got the spike, but otherwise, again, most of this pattern is not following because we had an important low, of course, here in early August. So we topped out in July, early August rally, all right, into mid-August drop. And none of that is on this chart at all. None of it. Where is the August 5th low? I don't see it, right? And where is the mid-August high? Somewhere I don't see. Where is then the early September drop? I don't see it. So this one is also not doing what it should do, or the market is not following as it should. But that is because this is an average. So we have now, of course, weeded out all the non-election years, and we're trying to compare apples to apples in our fruit basket. And so far, the fruit basket we have is completely different than an average fruit basket. Now, that's fine. So I guess we have a berry basket or banana basket, whatever, or vegetable basket, whatever basket, maybe a meat lover basket. I don't know. It's definitely not following seasonality. So seasonality is currently out the window. Doesn't mean it's not important. It's simply not working right now. All right, we'll put it on the back burner. So there you have it, right? Those are our insurance policies, and that's how it works with analyzing the markets. We have to make sure that we always have an insurance policy in place, which are often stop loss levels that tell us that what we are currently preferring is not what the market is doing. But for now, I have zero indication that is the case, okay? So I just have to assume that we're going to go higher, contingent on holding, of course, above these warning levels. So we have the insurance policies in place, and if those get triggered, we know also what most likely is going to transpire. That's the nice part. Then we see most likely this B/2, and if then these critical levels are not holding for that wave count, we're going to go to this. Okay, but for now, zero indication. Maybe on Monday we'll see it, but again, look at this where we are. We're at the upper Bollinger Band. It looks pretty strong. It looks like we're kind of somewhere here, right? If you do it comparison wise. That's all there is to it. Take care. Trade safe. Have a great weekend. And I'll see you all next week.